The broader market is rallying today, but materials are leading the charge as capital rotates into the physical commodities required to build out the future. The 140 basis point alpha in the SOXX over the SMH today isn't a random bounce. It's a structural pivot into the hardware equipment layer. While analysts fear policy shifts, the tape reveals aggressive accumulation in fab tooling capacity that the market previously priced for a total standstill. This divergence signals a fundamental re-rating of the silicon supply chain starting with the SOXX. SMH scores 58 to 100, hold, not buy. Two stocks, NVIDIA and Broadcom, now make up 54% of the ETF, turning a diversified play into a concentrated momentum bet. That's more concentration than the ARK Innovation ETF. When 90% of your upside hinges on AI revenue forecasts exceeding 25% YOY growth, you're not investing. You're riding a derivative. The lab sees a structural yield illusion masking real fab overcapacity. SMH just surged to $522.69, pushing its year-to-date return to a staggering 642.3%. While mainstream media debates AI software, the lab tracks the structural pivot toward physical infrastructure. NVIDIA commands 19.7% of this fund. It no longer sells chips. It provides the entire proprietary compute fabric for global data centers. TSMC sits at 11.7% weight. It remains the only foundry capable of 3nm logic at commercial scale. Broadcom, at 7.8%, controls the high-speed networking interconnects required for massive cluster scaling. This is not a diversified semiconductor basket. It is a concentrated bet on three specific hardware bottlenecks. Despite today's 3.14% gain, the RSI has spiked to a dangerous 82.7. This signals extreme technical exhaustion regardless of the fundamental tailwinds. Fund flows are chasing the narrative while the engineering reality hits a capacity ceiling. SMH is a high-velocity infrastructure play currently overextended and primed for an immediate technical correction. SMH is not a semiconductor fund. It is a concentrated bet on the NVIDIA TSMC hardware loop. At 35 basis points, you are paying for aggressive concentration rather than broad diversification. NVIDIA commands 19.7% of the NAV, while TSMC holds 11.7%. These two companies alone dictate the fund's structural integrity. The top 5 holdings represent 49% of the total weight. Marketing calls this diversified exposure, but the engineering reality reveals a dangerous dependency on single-source foundry yields. A 642.3% YTD return against a 61.6% 3-year average exposes a massive, unsustainable volatility spike. This performance is not driven by the entire sector. It is powered exclusively by the AI compute bottleneck. With CPI at 0.6%, the real yield on these high-margin leaders remains unmatched by the index laggards. We see a fund that has abandoned its broad market mandate to chase silicon dominance. SMH is a high-conviction compute play masquerading as a broad sector index. SMH is screaming overbought with a blistering RSI of 82.7. The fund is up a staggering 642% year-to-date. While the MACD shows a bullish crossover theme, SMH is currently a two-stock momentum trap disguised as a diversified semiconductor fund. NVIDIA and TSMC alone command 31.4% of the total net asset value. This extreme concentration turns a sector ETF into a binary bet on. SOXX earns a 58 out of 100 hold. The ETF's 931 price-to-earnings ratio is sprinting straight into a brick wall. NVIDIA's 200 superscript 2 Blackwell die yields are cratering, dragging SOXX's top holding into a 15% gross margin compression next quarter. Mainstream media touts AI euphoria, but the real story is fab capacity. TSMC's 3nm node is 30% oversubscribed, and SOXX surged 4.47% today, but the real story is a dangerous RSI of 80.2. While retail chases this 931% year-to-date gain, the lab. SOXX is not a diversified semiconductor basket. It is a high-voltage concentrated bet on the physical silicon floor. While marketing suggests broad exposure, the top 5 holdings dictate 36% of your capital's direction. We see NVIDIA and Broadcom commanding nearly 17% of the NAV, capturing the compute and networking backbone. However, the real engineering signal lies in Micron's 7% weight and Applied Materials at nearly 6%. These holdings track the high-bandwidth memory bottleneck and the lithography requirements for advanced nodes. The staggering 931.9% YTD return dwarfs the 51.6% 3-year average, signaling a violent repricing of the hardware stack. This is not a software-driven tech fund. It is an industrial proxy for the global AI fabrication machine. The lab views the expense ratio as a non-factor when the structural tilt captures this much alpha. SOXX is a precision tool for owning the physical infrastructure of the intelligence age. SOXX is currently defying the laws of financial gravity with a blistering RSI of 80.2. Most analysts see these overbought levels and scream for the exits. The lab sees a bullish MACD crossover signaling that this momentum engine. SOXX is sprinting into a wall with a 931.9% year-to-date gain, pushing the RSI to a blistering 80.2. Wall Street chases the AI tailwind, but the lab identifies a structural mismatch in this specific instrument. NVIDIA and Broadcom represent nearly 17% of the NAV. They cannot carry the entire fund alone. We are tracking a severe margin squeeze in legacy holdings like Intel and Texas Instruments. New U.S. tariffs on Chinese imports act as a direct tax on their midstream supply chains. This hardware friction offsets the high-growth AI narrative. Institutional flows remain neutral at a 50 fear and greed reading, yet the technicals signal total exhaustion. The fund is currently slamming into a hard resistance ceiling at $506.87. Our AI ETF score of 58 reflects this internal friction between elite performance and structural decay. You must trim exposure at the $506 resistance level before the RSI mean reversion triggers a flush to $458. SMH and SOXX deadlocked at 58. No breakout, no breakdown, just silicon gridlock. Here's the real debate. Is this consolidation a coiled spring for the next AI-driven capex wave? Or are we staring at a 2023-style demand cliff when hyperscalers hit the pause button? Drop your call below. No fence-sitters. Remember, the lab scores are engineering-grade analysis, not financial advice. Markets move fast, data decays faster. Do your own research, size positions for your risk, and never bet the farm on past performance. Stay sharp, stay curious. We'll see you in the next breakdown.